Hey everyone, and welcome. If you're gearing up for exams like SSC, banking, or railway, you already know how crucial this topic is. RBI's monetary policy. Yeah, you just can't skip it. So today, we're going to break down every single tool in RBI's toolkit, and we'll do it exam style. Ready? Let's get started.
So, you ever wonder, when prices for everything start shooting up during inflation, or when the economy just kind of slows down in deflation, what does the RBI actually do? How do they control it? Well, the answer is all inside their powerful toolbox. And today, we're going to open that box right up and look at every single tool.
Okay, so here's our game plan. First, we'll cover the basics of monetary policy. Then, we'll jump into the big three policy rates. After that, we'll look at how market cash flow is managed. And finally, we'll wrap it all up with a super quick, rapid revision just for your exam. So stick with me.
All right, first things first. What even is monetary policy? Well, think of it like this. It's the RBI's main strategy, its game plan, for controlling how much money is floating around in our economy. And why do they do this? It's really for two big reasons: to keep inflation under control and to make sure our economy keeps growing. That's the whole point.
Now, the RBI has two main types of tools in its kit: quantitative and qualitative. The difference is actually pretty simple. Quantitative tools are all about controlling the total amount of money out there. You know, the volume. How much credit is available? That's quantitative. But qualitative tools, they're more about the direction of the money. Where is it going? Should it go to farming or to small businesses? That's qualitative.
Let's kick things off with the quantitative tools and jump into Section 2, the big three. Now these are the heavy hitters, the ones you see in exam questions all the time: the repo rate, the reverse repo rate, and the MSF. Let's break them down one by one.
First up, the repo rate. Super simple. This is the interest rate that RBI charges when it lends money to commercial banks, like SBI or PNB. It's for short-term needs. So when banks are short on cash, they go to the RBI, give some government securities as collateral, and borrow money at this rate. The key thing to remember is RBI is the one doing the lending here.
And here's how it all plays out. If the RBI hikes the repo rate, right, it suddenly becomes more expensive for banks to borrow from them. So what do the banks do? They pass that cost on to us. Your home loan, your car loan, everything gets more expensive. Naturally, fewer people take out loans, and boom, the money supply in the market shrinks. The exact opposite happens if the repo rate is cut. This chain reaction right here, this is a classic exam question, so pay close attention.
All right, next up is the reverse repo rate, and just like the name says, it's the total opposite of the repo rate. This time, it's the rate at which the RBI borrows money from the commercial banks. You might be asking, why would the RBI borrow money? Well, it does this when there's just too much cash floating around in the system and it needs to soak up that extra liquidity.
So, what's the bottom line here? If the RBI offers a higher reverse repo rate, it's like a really attractive savings account for banks. They'll think, hey, why lend to the public when we can get a great safe return by just parking our money with the RBI? And that's what they do. More money with the RBI means less money in the market. Simple as that.
Now for the third of our big three, the MSF, or Marginal Standing Facility. The best way to think about this is as an emergency, last resort loan for banks. If a bank is in a real pinch and needs money literally overnight, just for one single night, they can use this window. But because it's an emergency loan, the interest rate, which we call a penal rate, is always going to be higher than the normal repo rate.
Okay, let's hit some quick-fire exam points for MSF. You absolutely need to know these. When was it introduced? 2011. Which committee recommended it? The Narsenham Committee. How much higher is the rate than the repo rate? Usually about 0.25%. And what's its role? It acts as the upper ceiling of the interest rate corridor. Memorize these.
All right, great job so far. Let's move on to our next set of tools. These are what the RBI uses to directly manage the day-to-day cash flow in the market. We're going to talk about OMO, MSS, LAF, and term repo.
First up is OMO, which stands for Open Market Operations. This is probably one of the most direct and powerful tools the RBI has. It's literally just the RBI buying and selling government securities, or GSECs, on the open market. By doing this, it can either inject a whole lot of cash into the system or suck it right out.
So let's walk through it. Imagine the RBI wants to pump more money into the economy. What does it do? It goes out and buys government securities from the banks. Now, when you buy something, you have to pay for it, right? So the RBI gives cash to the banks in exchange for the securities. And just like that, the banks have more cash on hand, and liquidity in the whole system goes up.
And of course, it works the other way too. If the RBI wants to reduce the money supply, it does the opposite. It sells its government securities. The banks buy these securities and pay the RBI for them. So money flows out of the banks and into the RBI's account. The result? Less cash in the banking system and liquidity goes down. See, it's a very direct process.
Now let's quickly touch on a few other tools. First, there's the LAF, or Liquidity Adjustment Facility. This isn't really a separate tool, but more like the framework under which the daily repo and reverse repo operations happen. Then you have MSS, the Market Stabilization Scheme. This is a special tool to absorb a massive amount of excess liquidity, and it works by selling special bonds. The name for this process is sterilization, a key exam term. Finally, there's term repo, which started in 2013. It's just like a normal repo, but for a longer duration, like 7, 14, or even 28 days.
Okay, so we've spent a lot of time on tools that control the total amount of money. Now let's switch gears and look at the qualitative tools. The goal here isn't about the total volume of money, but about guiding where that money goes, which sectors of the economy get the loans. Here are the main ones you need to know. First is margin requirement. Say you want a loan against a property worth 10 lakhs, and the bank only gives you 8 lakhs. That 2 lakh gap is the margin. If RBI increases that margin, you get a smaller loan, which discourages borrowing in that specific area. Next, PSL, or Priority Sector Lending. This is a rule that forces banks to give a certain percentage of their loans to important sectors like agriculture or small businesses. Then there's moral suasion, which is basically the RBI governor calling up the bank heads and persuading them to follow policy. It's a psychological tool, and if that doesn't work, the RBI can take direct action and slap penalties on banks that don't cooperate.
Phew, we've covered a lot of ground. So now it's time for what you've been waiting for, the rapid revision. This is your ultimate screenshot slide. A quick glance at this before your exam will bring everything rushing back. Let's nail this down. If the repo rate goes up, money supply goes down. If the reverse repo rate goes up, money supply also goes down. When the RBI buys securities in an OMO, money supply goes up, and when the RBI sells securities, money supply goes down. Finally, if the margin requirement goes up, credit supply in that specific sector goes down. This table is pure gold for revision.
Look, if you remember just one thing from today, let it be this core principle. Inflation means there's too much money chasing too few goods. So, to fight inflation, what does the RBI do? It uses all its tools to reduce the amount of money in the system, to decrease the money supply. And for deflation, well, it does the complete opposite. If you just get this one concept, I promise you, you'll be able to answer so many questions correctly.
If you found this explainer helpful, please do like, share, and subscribe to the channel. And definitely let us know in the comments if there's a specific topic you want us to cover next. Keep up the hard work, and all the very best for